Good morning, traders. Chris Buss here with Traders Profit Compass with another edition of Before the Bell, your home for actionable pre-market content. It is 6:50 in the morning as I'm starting the video on Wednesday, April 27th. And as always, please run your player at 1.5x. Quick look at futures. We're in the midst of a little rally here. Bitcoin up 2%, oil up 0.5%, equities pretty much 1% across the board. That's coming off of a 3-4% loss yesterday, so modest gains there. Nat gas is back over 7. Gold and silver are basically flat. Over in the macro front, we've got international trade, wholesale and retail inventories, pending home sales, oil inventory at 10:30, and we've got a 5-year bond auction at 1 p.m. Yesterday's 2-year auction apparently went really well. Strong demand for that, bringing yields down markedly. Earnings front, Boeing this morning, Spotify, Tech Resources, Humana, Harley-Davidson, ADP, and then this afternoon we've got Facebook, PayPal, Ford, Pinterest, Teladoc, Las Vegas Sands. So a nice mix of industrials, financials, tech, resources, healthcare, a lot of stuff to look at. So let's dive right into the charts. Here's my extremometer, basically looking at the ratio of puts to calls. We had a baby cluster last week and into this week where you can see we dropped below the green line. That's my demarcation line for excessive put buying. Came down in here, but then yesterday and would have been Monday, notice that we've got these histogram bars rising up, and even yesterday into the teeth of that decline. People were not panic buying into that decline. They were actually buying more calls than they, on a relative basis, than they were earlier in the week and into last week. So, anyways, the panic has come off the boil in terms of the option buying flows. I do want to point out a couple things. Notice that all throughout, up and through the beginning of this year and all of 21 and most of 20, coming out of this massive cluster of put buying during the COVID panic lows, that this line has only been exceeded, look here, just a few times, actually most of them in the beginning of this year. My point here is saying that things have obviously changed from the standpoint, this was all very strong uptrend, very little put buying, and actually these spikes lower, if you look back on the chart, are your tags of the 50, that buy the dip mentality. And I think that, this spike up are people that are trying to nail that bottom. So let's look on the oscillators. Here's the Nasdaq. I was surprised when this number came in last night that we really only moved the needle down to minus 53. So from our scale, we're really not even oversold yet. I mean, this is not minus 60. It's certainly not minus 90. So I think we have more to go on the downside before there's a legitimate shot at a sustained rally. I would characterize what we're in right now as an oversold bounce. I think it's going to get sold into. until we drive these oscillators lower. The NYSE is a little lower posture. As you see here, we're just tagging. Actually, we're at 65, so we are a little bit stretched on this metric, but I think the Nasdaq is the one to watch. VIX yesterday, again, a very nice read intraday. Having that panel up and visible during trading was really, really helpful. We had, we opened low. This was the rally on the prior day on, what was that, Monday. And then we came up and actually took out the prior high and closed on the highs of the session up here around 34. So if you're not accustomed to watching that VIX intraday, if you're an active trader, make sure you got a panel up because it is very, very helpful if you're trying to actively trade the market. This is one of the most interesting panels that I have, the volatility term inversion, where you get both the both segments, the 3-month versus the 1 month inverted, and then you got the 1 month versus the 9-day inverted. You can see in times past that has been a good buy signal, and so I mean, going long into the close based on this, I mean, you do have a bounce. I think it will remain to be seen. Does this result in a big bounce, or is it just something to get it out of oversold conditions, to pop it up a little bit, and then they come back down again? Remember, just in these last occurrences, we did get a bounce, but then it came right back. So, and also remember that all of these periods that I have shown here are all happening in bull markets. And we may be at a transition point where this volatility term inversion does not, it's not a one touch and then rocket higher. Maybe this comes up to a lower high with repeated oversold conditions, and that would look something like just a persistent downtrend where, and I'm talking about price, where you get a bounce, it's faded, then these go oversold again, you get another bounce, lower high, comes back, you're oversold again. You get that series of lower highs and lower lows where, yes, the volatility does get oversold and you do get a bit of a bounce, but this doesn't speak to the magnitude of the bounce. That's my point. It doesn't mean that bounce will be significant or something where you should take all your shorts off and pile in long because you're going to get, a 5, 6, 8% bounce. It's possible. This thing doesn't tell you the magnitude of that bounce. It's just going to tell you that the conditions exist to have one. SPY Daily, we closed down here at the March lows yesterday. I think that 415 is your pivot point this morning. If you got something, if there was a rally that came up into 424, 423, we'll look at it on the 60-minute chart. But I would be of the mindset of fading that. I have my doubts whether there's going to be a sustained rally, right in front of Apple and Amazon tomorrow. I think what you're seeing is a product of not only oversold conditions, but Microsoft apparently talked it up last night and put a big bump in the Nasdaq. So we got that. I don't think Facebook's going to move the needle. I mean, it's already been cut in half, but Apple and Amazon certainly can move the market and probably will. But I'm not sure how many people are really going to step in front of Apple's results. I think there's enough trepidation out there that people want to wait and see, and you might actually see people selling Apple on this little micro bounce into their earnings tomorrow night, fearing the worst, hoping for the best, but fearing for the worst, and stepping aside for those till those results print. Here's a SPY 60-minute chart. We have a level here at 420 that you can see there was a lot of touches yesterday before it finally gave way. Now we're in rally mode. I haven't looked at where we're at pre-market, but I think that would be a level to watch. And if you got, if price was able to take that out, 420, that's a good line to shoot against on the long side. And that puts you in a position to come up here to challenge this gap. But if somehow, some way, price made it all the way up to fill that gap at 428, I would be congratulating yourself, and I would be taking it off, or at least rolling up your stops and your strikes to that level, and then shooting for 431 on the upside on any kind of sustained rally today and possibly into tomorrow. Yesterday on the Qs, we closed dead on the lows after Microsoft and Google reported. It undercut these levels. Then Microsoft recovered. Google came partway back. We'll look at that in a minute. But I think your toggle point here today is 317, and that was your closing low yesterday. If price can get above that, I think you can make a run up here to 322, and then that would be a place where you could move up your stops and your strikes to shoot for a move to 330 if it goes that far. On the downside, we've got a measured move target out of this flag action that takes us down to the top of the gap, down at 305, 306. I think if there is a final type of capitulation, possibly after or a part of the Apple and Amazon reports, come down here, potential for a bounce off the top of the gap, or just go right on through and fill that gap to 300 and then look for a more sustainable bounce. Because at that time, our oscillators will be way stretched to the downside if we were to lose another $10 or $15 off of the Qs. Moving on to the hourly chart. Yesterday we talked about, we'd actually penciled in this little bear flag, and we said, if it went above, it's going to foil that bear flag look, but it didn't. It actually broke down and then sent out an early morning note on that bear flag target, and you can see that it pretty much after some consolidation made that move, actually broke this prior low back in March and this low here back in March. So really the only thing left is that February lows, and we're there right now. So very, very weak technical posture. IWM, bull trap, break outside the range, rejected by the 200, back inside the range. Whenever you leave a range, you never want to come back in. Otherwise, the target is the bottom of the box. And lo and behold, we are there right now. Any kind of break below, breaks and closes below 187.50, then the door is open for a measured move of, let's just call it $20 lower. So that is definitely, testing the bottom of the range. Any kind of break from this point kind of lets it loose. I did share with you yesterday the large trader that is looking out to June for a 185, 170 put spread. Did that over 12,000 times, and that aligns really, really well with the technical targets that we've been talking about for weeks. And even here on the 60-minute chart, we had the impulsive move down. We had the little bear flag action. And what I've done is I've taken this measured move and taken it off of the bear flag high. And I've got a measured move bear flag target of 179. So basically halfway between the breakdown and the final target. So if you're just thinking round numbers, 190 is the breakdown, 180 is the midpoint, and 170 is the final target. So this aligns very, very well with making a move down to 180 at that halfway point of the measured move target. Facebook, impulsive move down, consolidation flag sitting right here at 180. We've got earnings tonight after the bell. Looking at the daily chart, got a little line right here. That would correspond to the top of the box that I just showed you. Very weak technical posture. This is the weekly. Big move down. You could almost look at this as a bear flag. We talked about that yesterday on the weekly. A move, B move, C move. I think this is going a lot lower. You actually see that price this week has dropped down below the large volume over price bar support level. And so while this is below, it's really, really vulnerable here. And I'm not going to say earnings doesn't matter, because they do, but this is about as weak a looking chart as you're going to find. And then when you put on top of that, it's one of the the big fat man names. I mean, this chart is clearly broken. When you see this on a weekly chart, it's in real trouble. Now, can it save it here at 185? Sure, anything can happen. All I'm saying is I wouldn't be, it's going to be a long road to get this back to, even if it stops right here, it's going to take a lot of time to heal all this technical damage. I mean, it's been cut in half, 390 to 180. It's been cut in half. So, that takes a lot of time to repair. Apple down almost 4% ahead of earnings tomorrow. We had the impulsive move. I mean, all these charts, you should be visually recognizing these themes, because a lot of these charts are all acting the same. Impulsive move down, bear flag, final part of the move. let me just do that for you, just to show you kind of the process. There's your first leg down. And there's your measured move target, 151. Take the first leg, take that line or measure it. You can do it in points or you can do it in percentages. It's the same thing. Take that, extend it off the top of the flag, and that gives you the measured move target. And lo and behold, back at the March lows. And if you draw enough lines, you'll see that there aren't any coincidences. This stuff is all in the charts. When you get, measured move targets that comes down, within 50 cents of a $150 stock at the same exact point, there's more to it than just coincidence. So that's and that can come after earnings or whenever, but you can see here, and this is the surprising thing about yesterday. You see where the 200 comes in at 158, dropped right through it. And that shouldn't happen. And what I mean by that, you've got the largest, most important stock in the market, coming down, just, going right through the 200. You'd expect a hesitation. You'd expect a bounce. You'd expect something, but it just went right on through it. And so now we are at the bottom of this fairly wide support area where you can see support. Here's your February low. Here's your March low down at this 151 level. And that's, remember, just from the last chart, that's our measured move target. So it remains to be seen whether, when and if we get there, but that aligns perfectly with that March low. And then the issue then becomes the biggest, most important stock in the market is now well below its 200 EMA, and then that would put that chart on the wrong side of the market. So really, really important spot here for Apple and the market as a whole. We had talked about this setup yesterday. I hope you made a lot of money on it. And actually, if you did, don't forget, over in the show notes, there's a link to buy me a coffee. Kind of show your appreciation for the setups. If these setups or commentary or charts are helping you make money, helping you become a better trader, I'd really appreciate you thinking about making a donation to the channel. Help me keep the lights on over here. Help me support the work. Help show me you value the work, because I've put a lot of time and effort into it. And if it's helping, I'd appreciate the thought and the donation. But anyways, we said a lot of energy was building. We didn't know if it was going to go higher or lower, but we said whether you wanted to trade inside the range or wait for a breakdown or a breakout, that was fine. Have 980 alarmed in your system, and that was good for $100 to the downside, down 12%, straight line. Once it broke, big impulsive candles, no scary bars, no bounces, no reason for you to get out. So really didn't matter what you bought. All that mattered is that you bought. You know, if you were short yesterday, Tesla, you made a lot of money. And if you were hoping for a run to the top of the box, having that alarm at 980, if you honored your stop, it got you out before you lost a lot of money. And both of those things are very, very important. If you're wrong on what you plan to have happen, recognize you're wrong quickly, get out, and even if you didn't get short, you avoided a big loss. If you were totally flexible, leaf on a stream, oh crap, I was expecting a left turn and we just took a hard right, I'm going to get out of my long and get short because a break of 980 shouldn't have happened, and I want to take advantage of that downside. That's when you know you're starting to make some real progress as a trader, when you have that mental flexibility of planning and positioning for a long and realizing facts on the ground have changed and now you want to be short. Here it is on the daily chart. Here again, lost the 200, no bounce, no nothing, just a big nasty bar right through the 50, right through the 200, all in one fell swoop. And you know, I'm sure it's somehow linked to this Twitter thing. I mean, if you mortgaged or pledged a lot of your Tesla shares at 1,000, well, you just lost. You know, now you got to come up with the same amount of money, but your shares are worth 12% less than they were the day before. And then imagine if this keeps going, now you're kind of on the hamster wheel. The value of what you pledged is going lower and lower. So that means you got to sell more to get the money. So that's something to really, really watch. Now for today, I would just use the 200 as your toggle point. As long as you're below the 200, I think it goes lower. If it recovers the 200 and starts to put in a little bit of a bounce, then you can cover that and then recycle short whenever that, what I anticipate would be a bear flag, forms and then eventually breaks down. Here's Microsoft on the, let's go back to this 60-minute chart. I just want to show you. Closed on the lows, took out the prior lows right here, and then I just looked pre-market. It was trading up around 285 on the earnings moonshot. I think this is going to be faded. You are going to have a after hours high, which I think I'm not sure where it was. So you got an aftermarket high that price could gap and go this morning and run up towards that after hours high and then roll over, or they take it lower from the get-go. But I would certainly have Microsoft on the radar this morning in case they fade that big $15, $20 bounce. And you can see here we closed below the March and February lows here, so I thought that was significant. I don't know what was said on the conference call afterwards that made it skyrocket, because initially it had gone lower. And actually, now that I think about it, mark the aftermarket high and low, because that may be a technical target to the downside. You know, if this thing, I think it went down to about 260, so you would have a mark down here of the after hours low, and then you'll have the after hours high, and then that will be two important parts, because I think price is going to find a way to test that after hours low. It's just like the same thing we always talk about, marking that pre-market low and high, because price tends to find a way to test that. Amazon coming up with earnings tomorrow. It remains to be seen whether they want to buy it ahead of earnings or sell it ahead of earnings. But anyways, yesterday we filled this gap down to 27.75, and so now your closing low yesterday is your pivot point. We could bounce up here to the top of this little range, about 28.20, 28.25, and if we break below, then you're into 27.50 and the March lows at 2,700, which we know are really, really important. Here they are down here. And if you break below that, then going a lot lower. Notice the full bearish stack on Amazon, 200, 50, 28. And notice also the fast moving averages are really sharply rolling over, as are the 20 and the 50. And now you've got a pronounced decline in the 200. So when you've got all the moving averages moving sharply lower and you've got the full bearish stack, I mean, you know that that downtrend means business, because all these are going to be resistance levels on the way back up to the top. Google. What I've done here on the daily chart is we closed on the lows. We're already well below the March and February lows, so we took that out last week, and now we're plumbing new lows here. And what I've done is I marked last night's low down at 2,200 because it went down that far. It has bounced in the pre-market up to around 2,300. So today, what could it do? It could, it could flash up on this rally to fill the gap right here at 23.73, or it could gap down and test this pre-market low down at 2,200 first and leave this gap behind, or it could do both. Run up here, wherever it opens, run up and fill the gap, then roll over. So I think in either direction, you've got a $100 move in front of you. So I think that one is worthwhile watching for sure. Netflix, just going to show you the monthly here. We've lost everything, and I think this is heading to 125. Why do I say that? Because there's nobody home, and that's the next level of support on the monthly chart. And if price somehow found a way to have a kickback rally up to 250, breakdown, revisit the scene of the crime at 250. That was the big breakdown from back in the charts. That would certainly be a place to hit it, because I think it gets cut in half from there. And if you think about it, A, B, C, and that would make technical sense. That aligns well with the chart. And here's a trend line off of the 2005 low, and you're only coming up in here to $80. And remember what we talked about before. Heretofore, streaming was, valued as some special thing, crazy PE and all that kind of stuff. And maybe in the future, people just shrug their shoulders and say, yeah, that's how we watch TV. Just like we used to watch NBC, ABC, and CBS that all had PEs of 12. You know what I mean? It's just a media company. It streams over the internet. There's ads. Maybe there's a subscription fee. But they gotta create all this content that's billions and billions and billions of dollars. And at the end of the day, they don't really make a lot of money. So why should we pay a crazy price for it? And maybe that's what drives Netflix down to 125, or even back to the trend line, back here at $60. So we'll have to wait and see. Semiconductors. Here again, bear flag action on the daily chart. A leg down, kickback rally, measured move target, 215. We've been pointing in this direction for a while. We said focus on 240. If you got short there, I would be staying short. If you got short, on a break at 235, that's fine as well. There's some support in this 223 area, but then the measured move target is down towards 215. Take a look at Texas Instruments this morning. It reported last night. I think it was down maybe $15 or $20. I didn't look specifically, but I know it was down. So this is a classic risk on, risk off sector, and it doesn't take a charting genius to show a series of lower highs and lower lows, breaking prior support, heading lower. Very weak chart. I think it goes lower before it goes higher. But if you get, if in this rally you get a move back up into 240, that would be a place to hit it. Why? Breakdown, revisit the scene of the crime, back into the teeth of resistance. All these lows here are now resistance, and that's where your larger volume over price bars come in. So anybody that was still long from up here is trapped, and they will view that as a good opportunity to get out. Let's wrap it up there. Let's do a quick recap. Facebook after the bell, Amazon and Apple tomorrow. A little bit of a relief rally here. Let's see if they can build on it or they fade it. Remember, Jay Powell next week, May 4th, Wednesday, with the first of probably many rate hikes. There's no one happier than Jay Powell right now that the market's going down. Why? Reverse wealth effect. And if the market goes up, he's got the high ground with a bazooka, and he's not going to let it go up. So that will give him license to go even more aggressive. So with any positivity in stock market prices, I think Jay Powell and company are going to be right there to knock those people back into their foxholes with some bazooka fire from the high ground. So keep that in mind. I would not be looking for big time dip buying. All the bounces from here on out till further notice are technical oversold bounces. And stocks that have been cut in half are going lower. Stocks that have held up relatively well are, I think, are eventually going to break. Let me just show one last chart here. Morgan Stanley, we showed that the other day. See if I can jump over here to the weekly chart. See, here's a chart there really hasn't had a massive amount of technical damage. So if these markets go lower, you've still got some fertile ground, if we can look around the charts, and I'll help you find them, of stocks that have not been destroyed but have ample opportunity to go much lower from higher levels. And you can see here that all the moving averages are turning down, that kind of thing, and it's perched on this ledge where volume over price starts to drop off, and then you've got a massive void in the charts below. So stay on your toes. Hope you got something good out of the video. If you're new here, please subscribe, hit the alarm bell, jump over in the show notes, drop in your email. There's a link there to do that. Join the team. I'd love to have you. And let's try and make some money together. This has been Chris Buss with Traders Profit Compass. Have a good day of trading. Talk to you next time.